Adrian Mowat is with us now. He's Chief Emerging Markets and Asia Equity Strategist with JP Morgan. He joins us on a Skype link from Hong Kong. Adrian, it's a pleasure having you with us here. How are global markets poised, Adrian? Are we running into a wall once again?
Look, I think we've had some pretty decent rallies from the February lows. So emerging market equities are up just over 20%. We've had a turn in the dollar with, I suppose maybe we should say, strength in the yen and also to some extent in the euro. I think the momentum of that is coming out for now. And we move in the summer months. You know, typically you hear expressions like sell in May. And so I think investors are a little bit cautious about that. We do have some specific event risks, for instance, Brexit in the UK. And, you know, at the moment, the probability of the Fed raising rates is deemed to be very low by the market. I think there is a chance that the Fed will raise rates perhaps in the September meeting, and the market will spend a little time processing that.
Do you expect sharp reversals, though, for global stock markets from where they are?
No, I don't. Positioning is still bearish in equities, particularly in emerging market equities. So I'm talking there about the global funds that are still underweight emerging market equities. If we look at hedge funds, they typically covered their short positions, but they haven't moved long. And, you know, it is important to understand that the fundamentals are improving for the emerging market asset class. We do have more easing forecast. We will see less PPI deflation, which I think will be good for profits. So as we move into the second half of 2016, nominal GDP growth accelerates, the cost of money comes down, and we do expect to see ongoing inflows both for equity as well as
one has heard for many years now that the US stock market rally is done for. But, that market kept pushing higher. In many senses, an outlier. One of the strongest in the world for a while. And over the last 5 years, relative outperformance has been huge vis-a-vis emerging markets. Could an accident there spur a sell-off in EMs? And do you expect one?
Well, the answer is, of course, yes. The world's largest stock market, if it has an accident, which I assume means it falls, that would take down global markets. That's the way it works. We don't expect much upside from the US equity market, but also we think the market is well supported. Profit margins are at a high level. There were concerns about profitability, particularly for multinationals, because of the strong dollar. The recent reversal we've seen in the dollar is constructive for that. The other key concern had been to do with financials, with lower probability of interest rate increases. I think there is a chance that you get an interesting dynamic in which the US economy data is good enough for the Fed to start to increase rates. As they do that, financials probably, and I don't think the dollar necessarily rallies, and that would be viewed as a risk-on moment.
Where is the dollar headed, you think, Adrian? And, a dollar rising has typically been bad for emerging markets, but, the last episode of dollar strength did not lead to emerging markets selling off. EMs continue to do well. I'm talking about the most recent episode. Was that an outlier or has something changed fundamentally? The relationship between the dollar and emerging market stock markets?
Yeah, so look, I think the dollar bull market is over. We tend to refer to everything relative to the dollar, but really what we should be looking at is what's been happening with the euro and the yen. The European and the Japanese current account surplus has been rising. Investors who've been short those currencies have felt a fair amount of pain. Back in 2015, you had risk-off events such as the PBOC changing the fixing mechanism for the renminbi on the 11th of August. That caused short covering and a rally in the yen and the euro. We have seen that even with negative interest rates or the threat of negative interest rates, there doesn't seem to be a desire to go short these currencies. And if investors don't want to go short these currencies, they will rise because of their current account surplus. I think it's now very difficult to engineer a sustained weakness in the euro and the yen. Thus, you don't have a strong dollar anymore.
So you're saying rather than focusing exclusively on the dollar, look at where the yen, the euro are. I mean, and they've been
that's what will drive
going
the
exactly in the
DXY
opposite direction as desired by their respective central banks.
Right? Sorry.
So, I mean, you've got a Bank of Japan meeting on Thursday, you've got a Fed meeting, but let's just focus on huge interest in that BOJ meeting. What more can they do and what will they do in your assessment?
Okay, well, I mean, there's a lot of speculation about what they might do in terms of increasing negative interest rates, making it possible for banks to get money from the central bank at a negative interest rate. Maybe they go ahead with that, but I'm not entirely sure if it's going to impress the markets because, let's face it, we all scratch our heads when we hear the sort of term negative interest rates. How does that work? Does that mean I can run along to a bank in Tokyo and they pay me to take money out? I think there's a fair amount of suspicion that's probably not the case. One of the problems we have in the world today is everyone thinks the central bank can solve the problem. Japan needs structural reform. It needs to be easier for women to join the workforce. You need to reform the service sector more to add competition, to make the country more competitive, to increase its productivity per unit of labor, particularly with a shrinking labor force. This is the type of reform we need rather than cheap money, because if there's any place in the world that's proved that cheap money doesn't work, it has to be Japan. And I think this is also the story in Europe, that the market is no longer paying up for innovative central bank policy, because what they want to see is the governments of Europe improving the productivity and potential growth in these countries through economic reform.
And yet, all we see is more and more action from central banks around the world. Maybe that will change, but it's not changing as of yet, right? I mean, central banks are still primary drivers. How much they're driving is suspect now.
Well, I beg to differ. We have the ECB and the Bank of Japan doing these measures, where we had negative interest rates in Switzerland, Sweden, and also in Denmark. Those were put in place as a defensive measure to stop a lot of currency flowing in as the ECB started its QE program. So we really have two major central banks in countries in which they're failing to pursue an aggressive reform program. Our view is the Federal Reserve will take the Fed funds rate up by another 50 basis points this year, with two moves, one in the third and one in the fourth quarter. What we're seeing in the balance of EM is these are countries with inflation, and they are using normal monetary policy.
Okay. You expect Fed to hike by 50 this year, yet you said earlier that you think the dollar bull market is over. Dollar's not strengthening from here.
Well, my previous answer just referred to the fundamental situation in the euro and the yen, in which they are running current account surpluses. So every day there's a natural demand for both currencies. To work against that, you need to get speculative flows to short in the euro. And being short the yen and the euro was very, very successful running into Fed liftoff. You had the fastest period of dollar appreciation that we've ever seen in the 2 years prior to the Fed liftoff in December. Post-Fed liftoff, with the exception of 1984 when Reagan was in power, in the last 5 out of 6 Fed liftoffs, the dollar has weakened post the first Fed move. So interest rate differentials do not explain all currencies. It's very important to look at things like current account positions, and also what have currencies done in the last couple of years. Are they already discounting the development of an interest rate differential between the US dollar, the yen and the euro?
Adrian, lots of news stories nowadays about that big number, right? Some $8 trillion parked in negative yielding bonds. What's the right way to look at that? That big
I think
number.
the right way to look at that is from the
Yes.
perspective of the individuals running the money. So if you're running a pension fund, an insurance company, an endowment fund in Japan or in Europe, your core asset that you normally invest in is guaranteed to lose you money. And those investors are out there looking for opportunities. So with the end of the dollar bull market, I think the carry trade in EM will be developing over 2016. That will support EMFX. It should also drive down yields in EM and will be bullish for EM assets, whether they are fixed income or equities.
Okay, what happens in the meanwhile if yields rise even a little bit? I mean, what happens? Will we have a big accident in bond markets?
I do see an event similar to the 22nd of May 2013, which is when the Fed published minutes, which introduced a word called tapering into the English language. That proved to be highly disruptive for global bond markets. But the setup for that was that in April, Governor Kuroda of the Bank of Japan introduced their form of QE, as they called it, QQE. That caused a rapid in bond markets, so yields were compressed. Then you got the disruptive idea of the Fed tapering its quantitative easing program. That caused JGB yields to double in 1 month period, and it's caused a big sell-off in treasuries around the world. I don't think we're set up for the same dynamic as we were back in 2013.
Okay, just a bit about India, Adrian. We keep here in India saying that we're in a sweet spot. Are we really?
Look, I think there are lots of opportunities for India. The first sort of 2 years of the government's term, they appear to be doing the homework. We are now seeing evidence of a pickup in early capex. We have double-digit cement sales growth. We're seeing truck sales pick, which is usually a good leading indicator for the corporate capex. Now, one of the big issues that we've had in India in the last couple of years is that even though there's been a modest reduction in nominal rates, inflation has been falling, particularly industrial inflation, such as the wholesale price index. So real interest rates have risen quite rapidly. I think the dynamic for this year is we've already got building momentum in corporate capex, confidence in that enhanced as wholesale price deflation moderates and the RBI at the same time continues an easing program. So real rates come down. We'll see a lot in terms of announcements from the railroads sector, which will add to the increase in spending that we've had in roads. Now, let's not forget that last year the budget went up 55%. This year we're seeing about the same sort of move. When we look globally, India is going to account for a third of the increase in the world's population or working age population over this decade. There's a huge amount of interest in moving FDI into India for manufacturing. And I think you're going to see building economic momentum through the term of this government. And as is often the case, you get faster growth as you get closer to the election. And I think that's the dynamic we're going to see here.
How important is it that Governor Rajan continues at the RBI, gets another term?
I think Governor Rajan is highly respected by the market. Remember, he came in during the turbulent times of 2013. And so him staying on is useful for confidence in the markets. But I think it's worth remembering that we do now have a pact for price stability between the government and the RBI. And if his replacement is seen as coming from within the RBI or the general sort of technical community of central bankers, Remember, the current governor came from the IMF. I think that'll be fine for markets.
It's a pleasure, Adrian. Thanks very much for your time and look forward to more chats. Thank you.